Thank you for coming to have a listen to us today. And I'm going to run through our presentation. So just for the people that don't know us, I'm just going to give you a little introduction to Ultimate Products. We employ over 300 people in Manchester and China and Germany. Ultimate Products is the owner of a number of leading homeware brands. As you can see at the bottom, Salter, which is the oldest homeware brands in the UK, the houseware brands in the UK. Beldray, Progress, Clean Easy, and Petra. Petra we bought 18 months ago, which is a German brand, and the only license that we do have now is Russell Hobbs. We sell to over 300 retailers across 45 countries. So quite complex, because in all these countries, all the languages are different, all the certification is different. But that's what Ultimate Products does. Ultimate Products does complexity. So what sets us apart from our competition? Compelling customer proposition. Our products, our brands are sold just above own label. So our goal is to put beautiful products in everybody's home at the right price, which creates volume. For example, everybody wants a Dyson vacuum cleaner at home, but 95% of people can't afford a Dyson vacuum cleaner, £400, £450. So our Beldray vacuum cleaner, which does a similar job, are £99. Mix of growth and income. We are growing and we are giving more dividends. Resilient business model. We don't just have one sector of the market. So we sell housewares, we sell vacuum cleaners, we sell laundry, and we also sell audio, we sell heating and cleaning, because in some times parts through the year or in recessions as we have now, other products sell better than others. Ownership of the brands, as I just went through, we own 90% of our brands now. We've got a very strong balance sheet, and unlike a lot of people out there, we are currency and interest hedged, which is very, very, very important, especially the interest hedging. We've always been interest hedged. We didn't really need to do it over the last few years, but again, with interest now, I'm very, very pleased that we have done it. Investment in our people. Our graduate scheme that we started over 12 years ago is flourishing. We've got directors from it now. Katie Maxwell, who started on the graduate scheme, who runs our houseware business, which is a £40 million business. We've got Becky Beasley, who runs our online business, which is a huge part of the business now. She was from the graduate scheme. 60% of the people in Ultimate have been on the graduate scheme or are on the graduate scheme. It's definitely part of the spicy sauce in Ultimate Products. Established an international presence. We've been in Europe now for over 6 years, and it's growing rapidly. And I'm going to talk a bit more about Europe, because it is a real big focus of the business and a real big growth sector for us. Investment in our systems. We're very, very proud about our systems, not just our robotic systems, but our warehouse management systems. And leading in ESG, we launched our ESG last night. So on our website. So if you just go into our investor relations, ESG is there, and it is definitely market leading in what we do. We've had unbelievable feedback from other investors, and as some of our big customers is telling us, Tesco's, Primark, Asda, we are definitely the number one in this. It's really important to us. It's not a ticking box exercise. We've been doing this 3 years. We focus on our packaging. Our packaging is fully FSC now. We have taken the plastics out, the polycarbonates out. We've planted over 1 million trees just this year with a very, very good company, Ecology. Ecology is sponsoring COP27. It's a non-for-profit organisation that we've worked very closely with for the last 2 years. ESG is very, very important to Andy and I, but also the rest of the people in Ultimate Products. There's a committee of 22 people. There's 22 people on our ESG committee, and it's a big focus. Just to run through some of the numbers, all positive. So revenue, 154.2 million, up 13%. Adjusted EBITDA, 18.8 million, plus 41%. Adjusted profit before tax, 15.8 million plus 42%. Adjusted earnings per share, 14.7% plus the 14.7p plus 32%. Dividend per share, 7.12p plus 42%. And our net bank debt adjusted EBITDA at 1.3 times, which isn't bad after the acquisition of Salter, but as a team, we want to get that to 1 as soon as possible. I'm just going to go to page 7 and give you some of the operational highlights, which again, very, very proud about that we've actually got operational highlights, because a lot of businesses over the last 12 months haven't, because they've been firefighting, which is understandable. But we've got quite a few. These are just a few of our highlights, and we've got loads more coming up. So we did the Salter acquisition at the beginning of the financial year. That acquisition was fully integrated, and as you can see, has been extremely earning enhancing. The UK, it's all settled in the UK now, and our goal with Salter is now to launch in Europe. So in February, we have the biggest houseware show in Europe called Ambiente, and we are going to launch the whole of Salter housewares range, electrical and scales, in February to the European market. Petra was a brand that we bought 18 months ago in Germany, and we only paid 100,000 euros for it. And our first order from one of the leading supermarkets in Germany was €1 million. They've now given us another 2 orders, not as big as that, but they'll give us another 2 orders to launch the brand with us. We have also now delivered a small Petra range into our European distribution centre for online, and the initial sales have been fantastic. We're a bit sceptical because they've gone that well. And it was only a small range. So we've got more coming in, and we've got a wider breadth of range coming in. But Petra for Europe is extremely exciting. It's new. Everybody knows the Petra brand in Germany because it is a heritage brand. It has been in the market for a very long time, but it's just been out of the market for about 10 years. It was a very high-end coffee brand maker. So we've also brought Petra product into the UK to put online, and the sales on that over the last few weeks, again, have been very, very encouraging. As you all know, the global shipping crisis over the last 2 years has been horrendous. We managed that. We delivered on time. We took shelf space off our competitors. It is easing. Shipping is dropping. The price of shipping is dropping. It's now gone from $18,000 at its peak to around $3,000, and we believe this is coming down over the next month as well. It should be around $2,500 to $2,000. Our automated robotic system is fully launched. We have 1,000 tasks to get through. We've done 200, and we have saved thousands of man hours already. And this is a real big productivity gain and a margin gain, and a big focus of the business, because we want to grow this business to 500 million in the next few years, but we don't want to be taking on loads of people. We want to systemize the business and make it as focused and as easy to grow as possible. Our office is fully up and running. We refurbished our office 2 years ago. We have everybody back to work, and we have had since September. We need everybody back to work. We're always innovating, we're always teaching, and we always need to be together. And we feel this is really an important part of the business. And part of our ESG, we installed 1,000 solar panels on our 120-year-old mill. So quite a proud moment, actually. And now we installed it in August, and we're already seeing a 40% saving. Been a fantastic journey. And we need 12 months to see the real saving on it. But to get it all done in this financial year was a fantastic thing to do. Russell Hobbs, as you know, Russell Hobbs is a license, and we only had a 3-year license. So it was always a worry. Once we'd signed the license, after a year, we were always trying to sign it again. We've done a new deal with Russell Hobbs, who is a partner of ours, and we've now done a 4-year rolling contract with them. So it just rolls on every year, 4 years. And we've also now taken on the Australian market and the New Zealand market as a little add-on extra. And just something that isn't on here, which is really good, and is our our EU warehouse for online. We've been working to get this right over the last 12 months, and the last 3 months it's been fully operational. Now, it's not got the full range in, it's only got a small amount of the range in, but the sales are going up and up every week. We're selling in France, Poland, Germany, Holland, and we're now starting to get the electrical products in there. So over the next 12 to 18 months, our focus is to get it fully ranged and start ramping up the marketing. Online for Europe is really important for us. We see a big part of our growth in Europe. We're very focused on opening 10 big retailers, 10 more big retailers in Europe over the next 3 years. 50% of our growth from those 10 retailers and 50% of our growth from online. We're very confident that we can do this over the next 2 to 3 years. So I will just hand you over now to Andy.
Thanks, Simon. So yeah, this is the our profit bridge for EBITDA from FY21 to FY22. It can probably be summarized very simply. We had a core business that remained stable in terms of profitability, which I think, given the level of external challenge, was quite an achievement in itself. Plus, we delivered on the Salter acquisition, which took place right at the end of FY21. So the promises we made in the circular around what the contribution to profit would be, we've delivered on those promises, and those promises were earnings enhancing, which has been part of the growth in earnings per share. If we go on to page 9, we want to talk to you all today about really a bit with a focus on resilience. From an investment proposition point of view, and bear in mind some of us are also large shareholders, we believe we offer 4 things. First of all, growth. Our products, our type of product features on countertops all over the world. But for now, we're gonna focus on UK and Europe. Secondly, income. We distribute half of our profit after tax as we go along because we have a capital light model. Thirdly, as Simon's mentioned, ESG, and I would encourage you all to read the strategy that we released yesterday. But fourth, I think we offer as a business significant resilience when times are tough, and I think times have been tough and are going to continue to be challenging over the next couple of years as the economy enters into recession. So we've worked really hard since we IPO'd to make the business more diverse and therefore more resilient. You'll probably know already we have lots of products, so 3,000 products we invoice a year. That gives us huge opportunities at times like this, because even when the market for general merchandise is going backwards, there's always products that the consumer wants. And at the moment, what does the consumer want? Anything with an energy saving message, like air fryers, like slow cookers, and like airers. So very diverse in terms of products. Diverse in terms of channel, and you can see this here on the slide. On the right-hand side, you'll see that back in FY18, we were very reliant on the discount segments, where over 50% of the business was discounts. We've worked really hard to grow our, discounts is hugely important to us, will always be, but we've worked really hard to grow supermarkets. And now supermarkets and discounts are a broadly equivalent share of revenue, with online coming up on the rails. And we do expect over the next 2 or 3 years that supermarkets online and discounts have a broadly similar revenue share. So that gives us a lot of diversity, because all segments go through cycles. And when times are tough in one segment, we do have something else with other segments we can rely upon. We saw that a lot in the last 2-3 years for quite extreme reasons. So when retailers were closed, and it was often discounters that were closed as non-essential stores, we still had our supermarket business and we still had our online business. Also, customer concentration. back in FY17, over 40% of our business came from our top 2 customers. So a lot of customer concentration. Now our top 2 customers account for less than 20%. So we've worked really hard on that front. If you go to page 10, you'll also see that in the time since IPO back in 2017, we've worked really hard to I suppose, to pivot from license holder to brand owner. So back then, our second and third biggest brands were licensed. That was Salter and Russell Hobbs. And in FY18, 52%, about half our business was from brands that we owned. In FY22, 75% were from brands that we owned, helped, as you'd expect, by the Salter acquisition. But even the license that we still have, and we only really have one remaining license, which is Russell Hobbs, is on a much better footing. It's on a 4-year rolling basis rather than a 3-year fix. So we have much more visibility with that brand, and therefore overall a much higher quality of earnings. If we go on to page 11, Simon here is the founder of the business. I've been with the business for 17 years. Many of our senior managers have been with us for quite a while. And I do think we have an approach to the business which is more custodial in nature than perhaps might be the case with other management teams. And that is reflected in our sort of conservative approach to risk. So, for example, of course, we hedge our interests. I mean, so should everyone, but we're going to find out that many don't in the next few months. And we've got roughly 3/4 of our debt covered by interest swaps and caps. We have a very well-established hedging policy, which has been refined over many years, which means that when currency moves, we have time to adapt. So, for example, we entered FY23 with $57 million bought forward at 129. Now, that's given us breathing space to respond commercially to what is a much less advantageous spot rate at the moment, moving in a range of 110 to 115. And what that means, for example, right now is it's given us time for that reduction in freight rates to really come through. And our view is that the headwinds that currency represents in the medium term, because sterling is weak against the dollar, will be wholly offset overall by those reductions in freight rates as and when they come through. Just to give you some color on that, as Simon said before, as recently as 7 weeks ago, we were shipping at $8,000 for a 40-foot. Today, it's about $2,500. So, it's been quite a big move. We insure our debtors ledger, and if a customer can't be insured, our default position is not to supply. Better to earn less money and sleep at night is the rule we live by. And if we do make an exception to that rule, it's one that is typically signed off by our non-execs. So it's a matter that which me and Simon and Chris can recommend to the board, but ultimately it's a whole board decision. We have loads of headroom within our bank facilities, which run till the end of 2024. But more than anything, I would say is our approach to inventory. You know, we have well-established stock forecasting systems, which I think are better than most, and we do take a sensible approach to risk when it comes to inventory, and that means we're entering this very challenging period with a stock balance which is at the right level and has the right mix of stock. And we are highly unusual in the consumer segment in being able to say that. There are unfortunately hangover stock issues from the pandemic that others are having to deal with. Now, you might look at our stock balance at the end of FY22 and say, hang on a minute, Andy, it's gone up a lot since the end of FY21. That's for very good reason. At the end of FY21, the shipping crisis artificially suppressed our stock level. And so what we've seen during 2022 is a normalization of our stock levels. And we can see that reflected in the movement in our online business. Online during the first half of FY22 went backwards because of a lack of availability of stock because of the shipping crisis. As availability returned in the second half, online grew, and that growth has continued into FY23. So if we go to page 12, I've already covered the online piece. As I say, growth in the second half of 22, continuing into FY23, which is going to be quite different to other experiences. Most online businesses are seeing revenue go backwards against tough comparators. We're seeing revenue going forwards against softer comparators because of the shipping crisis. Just a word on international. We do see growth in the UK, but we do see the greater part of our growth coming from international and in particular Europe. We have a very low level of penetration outside the UK. We see, and in terms of that growth, we see half of it coming from online, mainly through the Amazon channel in Europe, and we see half of it coming from targeting retailers, and we have an objective over the next 3 to 4 years of opening 10 large European retailers, with maybe 2 to 3 being opened during calendar year 23. In this endeavour, we're very excited about Petra. As Simon has already said, it does seem to have started very well, although I don't want to jinx it. So we'll see how the next few months bring, but it does seem to have landed well. And we've also appointed Simon Hathaway as an advisor to help us open those doors in Europe. Simon was the commercial director at Action, probably Europe's most exciting retailer, took it from 300 stores to 1,700, 1,800, and is also someone who's worked with a large number of large retailers across Europe in an advisory capacity. Moving on to page 13. Just a bit of a heads up on something which may initially feel like a negative, but is very much a positive. What we're seeing with online in Europe is, and international generally, is an extension of product life cycles. So previously we sold 300,000 SKUs a year, and we brought 1,000 products to market every year, which is a pretty monstrous amount of new product development. So that broadly a 3-year product life cycle. That's now extending out to maybe 4 or 5 years, because products that in retail might have reached the end of their life can continue online. And with Europe, a product which is an international, we can resell products that we've developed for the UK market into those international channels. And what that means is we can just bring down our new product development from 1,000 products a year to 600. So still a lot of new products, a lot of newness that we can use in the business, but a 40% reduction in the effort to do that. And there's a clear operating cost benefit to that. Probably 60% of our human resource works on new product development, so it's quite sizable. But also it allows us to concentrate on those products that we do bring to market, to go deeper into the detail of those products, which is really important for things like Trustpilot reviews, and of course for Amazon and other online reviews. Simon's mentioned about investment in systems and processes. What we do is really complex, and it's really complex because we have 300 retailers, all of whom want to be supplied slightly differently. So most people in our space keep it simple by having maybe a smaller number of retailers, a smaller number of SKUs. We supply 300 retailers across 3,000 SKUs, and we do it to a very high standard of performance and service. And we do that by using process automation and automation. And RPA, robotics process automation, is the next step in that. So this isn't about little geezers walking around the warehouse picking things. This is about, this happens at server level. And it is about taking tasks off human beings and getting the robot to do them. So to give you an example, you know, up until recently, our warehouse colleagues would come in and would have to download orders off multiple platforms and create a pick note. Now the robot does that at 4:30 a.m. and they come into a pick note and they start work that much earlier and they crack on. Another example, we have a retailer that has 67 variants of price label. They place orders quarterly. And it used to take one of our merchandisers 7 days a quarter to basically raise the orders for their price labels. Now the robot does that, and it takes about an hour, and that resource is released up. Now the opportunity is again very clearly we have you know, the operating cost opportunity with this. That's very obvious. But for me, it's also very much a revenue opportunity. If we can release our talent from doing mundane tasks into tasks which do deliver value, then there will be a clear revenue outcome of that. But also scalability. If we're going to grow the business, and we want to grow that, you know, we sort of see 500 million on the horizon for us, the business has to be scalable, and just adding more people in to what is quite a complex process is often leads to diminishing returns. The robot and our general approach to process and automation makes the business much more scalable, which from an investment proposition point of view is super important. Okay, I'm going to hand over to Chris for page 14, who's going to go through the numbers in a bit more detail.
Thank you, Andy. So moving on to the income statement, revenue up 13% to 154 million. That's been driven by the acquisition of the Salter Scales business, which happened at the very end of FY21. Seen a resilient performance from the rest of the business, up by 1%. What's been really pleasing to see in the current year is the movement in the gross margin. So that's up from 22.2% to 24.8%. That movement is despite the 2.2% headwind that we saw from the increase in freight costs due to the supply chain issues which occurred last year in the shipping crisis. So that's been driven by three different things. Two of them are in relation to the Salter acquisition. So the Salter Scales business that we bought does have a slightly higher gross margin due to the precision nature of the products. In addition, our own Salter business that we had built up over the years, so that's the Salter SDA and housewares that we already had under license, we have 30 million of revenue in relation to that. Previously, when we didn't own Salter, we were paying a 5% royalty. So this year, we don't have the 1.4 million royalty that we would have been paying in previous years. And then in addition to that, the underlying business itself has been able to maintain gross margin despite the headwinds. That's been achieved mainly through trading, therefore changing the mix that we have in relation to what we are selling. It's redesigning products either to hit a different price point within the retail space, or going back and chipping back a little bit in terms of price that we're seeing from the factories. So we are continually going back to our factories and renegotiating prices to get the best for our retailers and the best for consumers, and also maintaining our gross margin. So gross profit up 27% to 38 million. Admin expenses only up 16%. We took on very few new heads in relation to the acquisition of Salter. Only 2 people were TUPE'd over. But we have seen an increase in headcount. So headcount is up from around 296 to 365. That's not been in relation to the Salter business. Where we have been investing in people is in our DC, so our distribution centre. So that's to help support the online business. So, you know, we are getting the stock into our warehouse. We then need to, you know, reparcel it up all out and making sure that we're sort of like meeting, you know, our customer expectations and our retailer expectations in terms of timing and delivery. One of the important aspects about that is that we've changed the model that we use in relation to the DCs. So many DCs worked off agency basis before, whereby you're getting agency staff in. However, we found that we were getting a very low quality of staff and we're seeing very high churn rates. So what we've moved to in the current year is an employment basis, whereby we've seen churn of staff go down and we've seen the quality of people that we have in the DC going upwards. So on the back of that 16% increase in admin expenses, tied with the 27% increase in gross profit, we've seen EBITDA go up by 41% to a record 18.8 million. Moving on to slide 15, we can see what has happened in relation to the revenue, so in a bit more detail. So supermarkets have continued to grow strongly, as we have seen over the last 5 years. As Andy has said, supermarkets are now our biggest sales channel. Discounters have gone back a little bit in the year, so on the core business, back around 8%. This is mainly because we've seen the shutters come down at some of our discounters, that they ended up being overstocked post-COVID. So they ordered based on the COVID boost that they had seen, and therefore at the moment they are holding too high levels of inventory. We are expecting them to work their way through that, and we're starting to see signs that they're open for business again. And in particular, we see that they will have opportunities over the next year with the cost of living crisis, as consumers look for more competitively priced products. Our online business, up 23% in total, core down 1%, which is a little bit disappointing following the quite strong growth that we've seen in the 3 or 4 years before that. What we have there is really a game of two halves. In the first half of the year, we had the challenges of the supply chain crisis. What we chose to do at that point, when we had a choice between 2 containers, one for one of our retailers and one for our own online business, we chose to ship for our retailers. We prioritized them over our own business. Which is perhaps in some way not great for our own online business, but strategically is better for us to have those long-term relationships with our retail base. This meant in the first half of the year, we had a suboptimal level of stock within the business, which suppressed and held back our online sales. Once we started to see the supply chain issues come back, and we saw sort of like more reliability and more boats were sailing, we were able to build back up stock again. And in the second half of the year, we saw online sales go up 20% year on year. Moving on to the geographical split, you can see there that the UK is up 9%, whereas international is up 22%. So we do see that we have a large amount of opportunity to grow internationally. So our penetration levels are significantly lower in Europe than they are in the UK. Currently, we get about £2 per consumer in the UK, whereas in Europe, it's only 10p per consumer. So that's where we really see that we can grow our business over the medium term. So moving on to the next slide, where we see the bottom end of the income statement. Depreciation and amortization up 27%. That's off the basis of the £2 million investment that we've made in our head office, which includes the investment that we made in solar panels on our roof. We expect that solar panel investment will be repaid in sort of like 3 to 4 years' time, because they'll probably provide about 40% of the energy of our head office. Finance expense up 62%. That's on the basis of a larger amount of debt, having gone into the market for more debt to finance the Salter acquisition. Our tax expense Roughly, we're paying a 21% rate, which is higher than the UK statutory rate of 19% due to the branches that we have in Germany and Poland, which pay higher amounts of tax. Adjusted profit after tax up 46%, statutory profit after tax up 69%. That's off the back of not having the exceptional costs we had last year in relation to the acquisition. So moving on to look at EPS. So although adjusted profit was up 46%, our adjusted EPS was only up 32%. That's because of the dilution factor of the shares that we issued in relation to the acquisition. So the acquisition was funded around 1/3 through shares and 2/3 through debt. So therefore EPS up 32%. The board is continuing with its dividend policy of paying out 50% of adjusted post-tax profit. So the dividend is increasing 42% to take it to a total dividend to the year of 7.12p. Moving on to cash flow and net debt, you can see that net debt is up marginally in the year to 24.4 million. This is still 1.3 times gearing, down from 1.4 times last year. So still a relatively conservative level of gearing. We do want to get it down further to 1 times. In the year, the big change has been our investment in working capital, which is actually better explained on the next slide, where we go into more detail on our balance sheet. So moving on to that next slide, you can see that our inventory has gone up by 7.5 million. As mentioned by Andy earlier, our stock last year was suppressed to a suboptimal level because of the shipping crisis, that we were not able to get the stock that we needed, the free stock, to be able to grow our online business. So that's what caused the online business to go down in H1. But as the supply chain issues eased up, we were able to build back up our stock. And that's when we saw online growth starting again, which grew 20% in H2. Debtors up a little bit in relation to trading. Debtor days at around 60, which is exactly the level that I would expect them to be. Up slightly from 57 last year, which is due to a mix towards the supermarkets, who don't necessarily tend to be the best payers and do have longer terms than our discounters do. So one more thing I'd like to point out on the balance sheet, which is slightly esoteric, down at the very bottom of the balance sheet, where we might not necessarily be looking normally, is on our derivatives. So our derivatives are valued at 4.1 million. Now, this is that 57 million of forward contracts, which Andy mentioned earlier. So that is our hedging strategy in relation to currency. So we buy forward so that we aren't exposed to the movements in exchange rates. In addition, we also have caps and swaps in relation to interest, making sure that we're also hedged in relation to our interest rate movements. That value has gone up quite significantly in terms of the fair value of them, as sterling has fallen and as interest rates have risen. Obviously, that's the fair value on the balance sheet, but we aren't about to sell those derivatives. We're going to use them to support trading, and that will especially support our gross margin going forward into FY23. So handing over back to Andy to talk about the outlook for the current year.
Thanks, Chris. I just wanted to reflect on the last 3 years, really, which might seem a bit odd when we're talking about an outlook statement. You know, it's been we've been subject to quite phenomenal supply side challenges. And don't forget, we were one of the first to be affected by COVID because of our China manufacturing base. So, lockdowns in China, lockdowns in the UK, port congestions, Brexit, of course, container ships blocking the Suez Canal. We had 12 containers on that ship, including 100 containers stuck behind it. Port closures in China, a haulage crisis across UK and Europe, the shipping crisis we've mentioned, Omicron, and now ongoing strikes at Western ports. It's not just the UK, by the way, which is going on strike. It's some European ports as well. So, we've dealt with this immense supply side challenge. And yet, compared to FY19, we've delivered a 75% increase in EPS, which would have been better without those challenges. We've delivered that despite those challenges. So I think it's probably fair to say we have confounded expectations over the last few years, and many people have said that to me. Now, as the supply side challenges fade and we're faced with a demand side challenge, we want to confound expectations once again, because the market for general merchandise is going to be smaller because of the cost of living crisis. But even though it will be smaller, it will still be very, very, very large. And our job, as a relatively small player still, is to take market share, and that's very much what we intend to do, both in the UK, but also particularly in Europe, where our market share probably rounds to zero, to be frank. There's plenty to go at there. It helps that we have a value offer. It helps that we have fantastic brands, etc. But for me, in the same way that we overcame the supply side crisis, it's going to be similar again. Really, it's going to be about a relentless focus on execution. Being better than everyone at everything we do. And I hope some of you who are more familiar with us will recognise that culture from previous presentations and from your contact with the business. Being relentlessly focused at being the best at every element of what we do. So inline guidance, you can read it on screen. Unusual, I think, for a consumer goods business. So that's us, Hannah. So happy to hand over to questions.
Have you made significant progress in diversifying your supply chain away from China?
So I'll pick that one. Simon might well add to it. So I think just in the way of context, I mean, we've spent a lot of time diversifying the business. We've shown some of that: products, customers, channels, and even within our supply base, we have 230 manufacturers, none more than a couple of, no individual manufacturer more than, say, a couple of percent of our purchasing. But of course, the concentration on China as a territory is an issue. It's one that we recognise. I would just qualify that a little bit. The West buys nearly all of its consumer goods from China. So this is an issue and a challenge for everyone, including the likes of Apple, by the way, as we've seen in the news, who supply consumer goods. I do think there will be a retrenchment of trade with China, but I think it's going to be more likely with more strategic industries like mobile telephony and the things where there's perhaps a security. I don't think anyone's overly worried about kettles and toasters to give an example. However, it is a concern for us. It is something that we are addressing. We've set our buyers targets to diversify away from China, and indeed part of their FY23 incentives are based on that. So it is really important to us. We don't take it lightly, but it will be gradual. It will be gradual, such as the West's reliance on China for consumer goods. It's not going to be an overnight process. It's going to be diversifying maybe 1 or 2% a year over a longer term.
I mean, the irony is about some of this is that China is best from an ESG perspective at the moment, that quite a lot of the places that we have looked at have not been able to meet the ESG standards that we want them to reach. So, you can go to factories elsewhere in the world and you mention the ESG problems and they not quite laugh in your face, but go, well, that's impossible. It's going to cost you so much more. Whereas actually China has been quite good when we've gone along in terms of dealing with those issues in terms of changing the packaging, in terms of reworking in the way that they are doing things. So for my mind, the biggest challenge in moving is to see the rest of the world get to that same stage, which may sound odd because we usually talk about, you know, China being quite poor in relation to the E side of ESG.
Thank you. Then sticking on the subject of China, if I understand correctly, you have had virtually no manufacturing disruption caused by China's zero COVID policy since 2020, with issues limited to logistics. Is this down to intrinsic factors related to your sourcing, luck, or have reports of disruption been exaggerated?
Oh, we've had loads of disruption. We've had loads of disruption, haven't we, Simon?
We've had plenty of disruption. I would say the part of our success, again, is our people. We've got 45 people in our Guangzhou office. We've had a Guangzhou office for 20 years. The managers that are there have been with us 20 years. We couldn't have done it without them. We had the people on the ground, so we were in the factories all the time. We were making sure the materials had landed, so the productions can start. But we weren't missed out. There was a lot of issues, but the way our systems work and the amount of weeks we give to make things happen, we did a good job. It wasn't as good as our KPIs normally are, but we did do a very, very good job. And it was down to having people, our 45 team members in China, running around, making sure things happened. But if you have a look at our operational director, Dave Bloomfield, he's definitely aged a lot in the last 2.5 years.
Thank you. Cash flow was weak in FY22 as a result of stock build and increased debtors. Do you expect better cash flow in full year 23?
Well, certainly our analysts expect it to be better. So pointing to the analyst notes which are out there, they would be expecting our net debt to fall to 1.1 times gearing, or to around 21 million from the 24, which, if you consider, you know, our dividend policy and the amounts that we will need for capex, etc., that would sort of like show an expectation that our investment in working capital would be significantly lower.
Thanks. To achieve your 500 million revenue in 5 years ambition, how much of that growth mix do you see as organic and or acquisitive?
Well, I don't remember saying 5 years, but yeah, well, sorry, Simon.
Yeah, we don't need to acquire anything. We've got our brands and our products and our people to really push it. We don't need to buy anything. If something cheap comes along, maybe something in France, you know, as a brand, but we've got everything. We've got everything we need to do the job.
Thank you. I see your all-in net zero target is for 2050. Once you've measured a baseline, will you introduce intermediate targets? When will the first one be? And what sort of path do you expect reductions to take? Straight line or mostly at the end of the period?
So I think, the Jill, who's our non-exec chair in the ESG committee, and Craig, who's been the key sort of executive driver. Obviously, they're not on the call and not able to answer this, but we will be providing intermediate targets. I don't think, and the question around will it be, how will it be profiled? I don't think we're in a position to answer now. I think intuitively I would expect that it would be, you know, a sort of more linear progression rather than you know, not much progression and then a lot at the end. That feels a bit like cheating, doesn't it?
Thank you. How secure are your export markets?
We heavily export into Europe, so you know, fairly open. So our biggest market is Germany, followed by sort of like France, the Netherlands, Poland. So we aren't sort of like going into particularly sort of like international. And we do have big pan-European retailers who we sell to. So, one of our biggest customer is a pan-European retailer who we sell heavily to in the UK and across every single one of their European territories. So yes, they are as secure as our UK revenues.
And they're all insurable. We won't
Yeah.
supply anybody that is not insured. So it's on that level, definitely.
Well, that's it for the questions. There's plenty of congratulations to you all too, which I echo. Thank you for the presentation, and we look forward to catching up again in 6 months' time.
Great, thank you. Thanks
very
everyone
much.
for your time.
Thank you.